Welcome to another episode of Strictly Business, the podcast in which we speak with some of the brightest minds working in the media business today. I'm Andrew Wallenstein with Variety Intelligence Platform. As any producer can tell you, financing film and TV production has changed a lot over the years. So to get some perspective on where it's been and where it's going, who better to talk to than someone who's been active on this side of the business for nearly 3 decades. In today's episode, I'll talk with Daisy Stahl, head of the Entertainment Finance Group at California Bank and Trust. We'll be right back. Talking today about changes in the ways TV and films get financed with Daisy Stahl, head of the Entertainment Finance Group at California Bank and Trust. Thanks for being with me, Daisy.
It's a pleasure to speak with you, Andy.
Cool. So I want you to paint a picture of the before and after, because for a very long time, there were certain tried and true ways to do what you do. You sold a script and then secured distribution from all over the world, or you bonded a film. It's not quite that simple anymore, is it?
No, it's not. As revenue models change, we all in this ecosystem have to change alongside, the revenue changes. So what I'd like to start out with is kind of lay a foundation of what has been in practice and developed over the past 35 to 40 years. So there has been a very developed ecosystem that involves producers, distributors, and capital providers. What I mean by capital providers, I represent bank financing, financial institutions. And the way that the distribution model worked in the past is that you could write a script and you could pre-sell it to one distributor or 30 distributors around the world. And those contracts they came in a form and developed over time where financial institutions could reliably lend against them. And that developed over time. So it involved multiple aspects, including very, I hate to use too much legalese, but notices of assignment, where distributors knew that a bank would need a certain legal document and waivers to certain aspects of their distribution agreements in order for the producer to obtain bank financing. So they knew that they had to work with their financial institutions and the bank partners in order to support that producer making its content.
It's hard for me to imagine that kind of system persisting in a world where the streaming services have sort of reconfigured the global entertainment landscape.
And that's where, it felt equalized, 20, 30 years ago. Distributors needed to cooperate in order to obtain content. Producers needed to work with the banks to determine what form the contract should look like in order for them to obtain the financing. So usually you would have these 3 parties working collectively to support the production of film and TV. What has happened over the years is revenue models have been really upended. Now, in the early days of streaming, it actually simplified things. So you had, rather than 30 distribution agreements that, I'm representing a financial institution, I would have to lend against 30 contracts. I could lend against one. It could be a major conglomerate with a streaming platform. So in that sense, it made it slightly easier. But on the other side, the streamer represented, they're a large conglomerate. They had a lot more leverage. And when you have leverage, you can dictate more of the business terms. And that's what started to happen. Everybody was, there's this proliferation of production, a lot of content being produced, film and TV, over the past maybe about 7 years.
Okay.
And as the content was being produced and there was a lot more volume and the streamers needed less, they started to have the shift in leverage. They could dictate terms. Once upon a time, somebody could produce a film with equity, and then maybe there could be a bidding war, and it might be 3x the production cost, unbeknownst to the streamer who was picking it up. Then there were other terms that you could pre-sell to a streamer, and there would be a fixed margin embedded in that contract. So maybe 150% of your production budget. So you could have a 50% margin. And over time, that margin has shrunk, where instead of 150%, it could be 115%. So there's not that much margin for anything like over budget or financing costs that may have not been included in the original budget. And now where we're seeing contracts is the streamer or the distributor, I'll use them kind of interchangeably, may not pick up worldwide. They may only pick up domestic. So it leaves the producer left with, okay, how do I sell the rest of the world or a specific territory? So it has really evolved over time, and the leverage seemed to be held by, the bigger streamers. And so it really tightened margins for the producers. Producers had to give up the intellectual property in perpetuity. So now when they produce content, it's like a producer for hire. You produce it, you make your margin, you don't own the IP, you can't build a library. There's no further value from that IP that you built. That value is now owned by the streamer or distributor.
Just one of the ways that being a producer has gotten very difficult in this town. And also, what about like non-exclusive rights for other windows, like fast channels? I mean, this didn't even exist 5 years ago, I'd guess.
Yeah, so that I would put in a different category. So when what I was previously discussing was about new content and producing new content. There is a separate area of existing content. So what has also happened over the years is there's been a lot of capital going into the system to acquire existing libraries, because there is value in these existing libraries that, first of all, they are not owned in perpetuity by a streamer, so they can be exploited around the world in different different and emerging platforms. So when we talk about fast channels, that is for existing content that has been exploited in free TV is now going to other ancillary windows like fast channels on a non-exclusive basis. And with respect to that kind of business model for existing libraries, it actually helps expand the revenue generation for that content because it's non-exclusive.
Got it. So a distinction between old and new content. But you've talked about the shift in the revenue models. I mean, wasn't it always as simple as just a fixed licensed fee? Is that not that simple anymore?
No, actually, it has evolved even within the past 7 to 8 years. So it initially started as a fixed license fee for the IP in perpetuity. So the producer didn't own it anymore. Then it transitioned to a fixed license fee for 20 years. Then it moved on to a fixed license fee for maybe 15 to 20 years, but now it's only a certain territory. So now I've seen maybe 2 streamers picking up. One has a specific territory or window timeframe, and the other has the rest. So I've seen 2 streamers pick up one specific IP. Now I've started to see, and this is really in the infancy stage, where it looks more like the traditional split rights deals that were happening in the 90s and 2000s, where one domestic distributor, and let's say it's a streamer, will pick up specific rights, And then the rest of the world will be available to sell to others. And the producer could hire a sales agent to monetize the rights that were not picked up by that streamer. And now I'm starting to see contracts that are not a fixed license fee from the streamer, but look something like a rev share, which actually gives me hope. Because rather than just a fixed license fee, in the sense of a fixed license fee, you just have one fee and you can't monetize in any other ancillary windows. The revenue stops there. But if you have a rev share agreement, everybody's on risk to monetize and keep monetizing beyond a certain platform into other platforms. So the distributor wants to make, additional revenue. So they are going to distribute in other areas, and then they're on risk. And then the producer has potential upside rather than that one license fee. So there's a risk reward analysis that you have to do. So you can have certainty with the fixed license fee, but you miss any upside. If you do the revenue share, you have to have confidence in your partner to exploit the content and increase over and above what you would have received for that fixed license fee and take the upside.
Got it. Now, I want you to put this also in the context of what you do coming from a bank, talking, whether it's senior debt, private credit. How do those sort of different financial tools come to bear here?
Well, 20, 30 years ago, a producer could get their film made through pre-sale contracts and no equity required. It could be fully financed by a bank. But over time, with the soft international markets and fewer distributors offering pre-sales, it has required additional forms of capital, such as equity and or private credit, which is really defined as non-bank lenders, to step into the shoes that the banks traditionally held. So now you have multiple forms of capital to produce one project. It could be equity, private credit, and a bank facility. And so they all have different costs of capital. It makes it more expensive for the producer. So, those interest charges eat up what they would otherwise spend on production. What has now happened is because if there are very few pre-sales, then it might be easier for the producer to just equity finance the whole project. So I do see in independent film, many projects are produced with equity that is provided by not institutional equity like big funds, but more high net worth and family offices on a project by project basis. I also see a lot of private credit come in or trying to penetrate this space because they see that there's a need. There's a big gap between what banks can provide and what they can lend against and their risk tolerance and equity. So private credit, I've seen a lot of folks trying to come in and provide that financing to independent producers. I've seen some done. I've seen some trying to penetrate the space because it's definitely a need that has been identified by those outside of our industry.
I remember the days where, you'd have private investors come in and be passionate about a particular project, or I remember the big days, slate financing, or do we still see these kinds of arrangements?
We do see them. It's harder and harder to raise the capital for them. So 15 years ago, every studio had a slate financing or maybe multiple slate financing partners. Every major studio out there. And then those slate deals, they wrap up in 5 years and then they have to find a new partner. It has been harder and harder to find partners, not because of the lack of desire, but usually if you're looking for a slate deal, it's got to be 200 million, 300 million in equity raised. So that institutional capital is not as interested in film and Ko-Fis today as they were 10, 15 years ago. Unless it's known, a studio with really known IP, if they've got some major franchise that they're forecasting to have huge wide releases, in the near term. But, that institutional capital is not completely dried up, but it's definitely lessened in the past 3 to 5 years.
We'll be back in just a moment with more with Daisy Stahl from California Bank and Trust. Stick around. And we are back talking with Daisy Stahl, head of the Entertainment Finance Group at California Bank and Trust, about the ever-evolving world of financing content. And well, I also, Daisy, wanted to get your perspective on something that's not quite financing content, but is something that I know must be figuring more into your conversations about financing in Hollywood, and that's AI, which, as you know, is sort of working its way into sort of every little nook and cranny of the supply chain. From your perspective, explain how AI is now figuring into investment opportunities and the role you could play.
Well, I see it from two different sides. So there are the creators that can utilize AI to reduce production budgets. And with softer pre-sales, the need for capital, that could make the difference between making a film and not making a film. So I could see uses of AI to help more films get financing. Now, with respect to the finance side, I haven't heard of any AI tool yet, but I do see some potential on, kind of on the financial side of the business, in particular, complex contracts that have very complex waterfalls. So, what a waterfall is that, if there is some kind of intellectual property that generates revenues, there can be many participants in those revenues from the day that it's released and exploited to, 10, 20 years down the road. And that intellectual property and the revenue waterfall, we call it participations, or in the music space, it's royalties. Those are complex contracts that have entire groups called participations and residuals. And oftentimes, generally they're reliable, but it takes a lot of people. Oftentimes, the recipients of the participations, maybe it's talent, maybe it's the director, the producer, they may have some questions or discrepancies, and then there are processes that are referred to as audits, and they go back and they audit their participation statement or their royalty statement. Well, the use of AI, in my opinion, I'm not a technician, but it could be supported by, it could support these manual processes to reduce the time that it takes to determine the participations and the respective amounts for each individual. It could decrease potential errors in those calculations, or alternatively, you could use it to audit and come to a resolution of the audit results faster.
I see. I'm surprised we've made it this far into the conversation and interest rates haven't come up. So I feel like I got to throw that out there for you. How is that figuring into the current investment picture in Hollywood?
Well, it definitely eats away at potential dollars that could go towards physical production. So on the one hand, that's the direct impact. On the other hand, when assets are trading in the market, and what I mean by trading, so you can sell a film or TV library, you could sell a music catalog. The way that these catalogs and libraries are valued is basically taking a forecasted cash flow over the next 10 to 20 years. You use an interest rate, which we refer to as net present value. And when interest rates increase, it decreases the valuation. So that's put a little pressure on valuation of these kinds of assets. Nonetheless, if the assets have strong cash flows, there's still interest out there for financing them and for equity to acquire them.
Okay. Good to know. And look, we've talked a lot of film and TV, but you know the music world as well. And so I'm curious to get your sense, almost on a comparative level, just in terms of the attractiveness of music as an industry for investment.
Yeah, I've seen a lot of capital go into the music space over the past 10 years. Music went through the digitization 20 years ago, 2000 to 2010. And that's what film and TV is going through now. So music had to go through its challenges, and the revenue models have stabilized, have been fairly stabilized, and the cash flows are very reliable from an investor's perspective. So we've seen a lot of equity coming into the space to acquire catalogs or to support firms that are aggregating and acquiring catalogs. We've seen a lot of capital, both bank debt, private credit, and equity going in to support operators, so music publishers, music labels, to provide capital support to those firms in the music industry, acquiring catalogs, exploiting catalogs. So it was very hot. It's cooled down a little bit, but it's still a very stable part of the business for capital providers.
But when you put in perspective, that historical perspective, as you did, TV going through the digitization that music and film did 10 years ago, what's the takeaway then for TV? Should we be hopeful that maybe the turbulence of today will give way to a more stable ground tomorrow?
I'm hopeful. It just takes time, and people have to determine how the revenue model is going to work, because it's unsustainable if a platform is taking rights in perpetuity. What is that platform? How are they going to continue to monetize? How is the producer going to continue to monetize? There is an ecosystem that needs to survive with revenues generated so that they can use that capital to deploy and continue to produce new content. So, it took many, many years for the music industry to stabilize and find a revenue model that worked and was sustainable. And I think, it's going to take some time, but my belief is, having gone through this and seeing how everything has evolved over 30 years, I am hopeful that the revenue model will continue to evolve in the next couple of years. There will be more revenue sharing. The form of how that occurs, I can't predict, but I am hopeful.
Well, seems like a good note to end on. Hope is always a good thing. Daisy, thank you for walking us through this today.
Pleasure.
Thanks for listening. Be sure to leave us a review at Apple Podcasts or Amazon Music. We love to hear from listeners. Please go to Variety.com and sign up for the free weekly Strictly Business newsletter. And don't forget to tune in next week for another episode of Strictly Business.